Most borrowers think bank statement loans are a loophole, an easy way to get approved without tax returns. But here's the truth. Bank statement programs weren't created to bypass underwriting. They were created because tax returns simply don't reflect reality for millions of entrepreneurs and investors. And if you understand how these programs actually work behind the scenes, you'll know exactly how to qualify and avoid the mistakes that cause unnecessary denials. Here's the twist. Bank statement programs aren't no-doc, they're alternative documentation. Instead of relying on taxable income, numbers reduced by write-offs, depreciation, and business deductions, lenders evaluate the money that actually hits your account. Real deposits. Real cash flow. Real ability to repay. Let me give you a real scenario. A borrower was declined by a bank because his tax returns showed $42,000 in taxable income. But his business was depositing over $28,000 per month. A bank statement lender approved him instantly because they underwrote based on actual deposits, not IRS-adjusted income. That's the purpose of the program. Reality over paperwork. And the data backs this up. A 2020 Urban Institute report showed that more than 30% of self-employed borrowers appear underqualified on taxes even though their cash flow is far stronger. Another 2022 ICE mortgage study found that bank statement programs cut false denials by nearly 40%. These loans aren't risky, they're simply more honest about how entrepreneurs earn income. So here's the truth about bank statement programs, good and bad. Truth 1. Lenders don't look at total deposits. They apply an expense ratio, usually 50% for business accounts and 10 to 20% for personal accounts. Why? Because deposits are not the same as profit. Lenders want to estimate real usable income. Truth 2. Consistency matters more than totals. You can show $40,000 a month in deposits, but if it spikes up and down without explanation, the lender sees risk. Predictable cash flow gets approvals. Random peaks get questions. Truth 3. You must be able to prove business ownership. Bank statements alone are not enough. You need your LLC documents, business license, and sometimes a CPA letter confirming your role. Truth 4. Bank statement loans aren't low-rate programs. They cost more than conventional loans because the lender is taking more underwriting risk. That said, a slightly higher rate is often worth the ability to qualify without tax returns. Now let's get practical. Step 1. Gather 12 or 24 months of bank statements, whichever gives you more consistency. Step 2. Identify your average monthly deposits. Create a simple summary. Step 3. Separate business and personal accounts. Mixed accounts create confusion and delays. Step 4. Prepare supporting documents, LLC documents, EIN letters, business licenses, or CPI letters. Step 5. Be ready to explain large deposits, cash spikes, or unusual activity. Clarity wins approvals. Here's your payoff. Bank statement programs aren't a shortcut, they're a fairness system. They help self-employed borrowers, investors, agents, truckers, barbers, contractors, and small business owners qualify based on the income they truly earn, not the income they report for tax strategy. Educational content only. Not financial advice.